Welcome to the Foundry, where leaders are forged daily. And now your host, George Roberts.
Welcome back, entrepreneurs. Today we have Christopher Nelson, who is an experienced technology executive with 2 IPOs, real estate investor, author, and the principal and co-founder of Wealthward Capital. Wealthward Capital is a real estate investment firm with a diverse portfolio of over 3,000 multifamily units, mobile home parks, and ATMs. Christopher helps technology employees achieve their financial independence through financial education and creating passive income portfolios. He is also finishing his book, From No Dough to IPO. Welcome to the show, Christopher.
Hey, glad to be here, George. Thank you so much for having me.
Well, you have an amazing story, and I think you can just start it out anywhere you want to begin, whether it's with the IPOs and how you merged into real estate, or just pick it up wherever you like.
Well, I think where it started, and I think, again, with the concept, which I love here, the Foundry, right? How do we found something, and I think for myself, I was so focused externally, right? As a young guy getting into tech, like I want to be a founder of something, or I want to help somebody else because I wasn't sure what my own ideas were. I think the thing that I'm focused on now is how do I be the founder of my financial independence? How do I really make that the focus? And I think where that happened for me is it was when I went through my first IPO, and all of a sudden we had this, large amount of technology equity. It was really, how do we solve this problem of getting all of this equity outside the market and getting it diversified into real estate so that we have that diversification? And so that's where I think, I think would be a good point to start the conversation today.
Yeah, I love it. Those are, as they say, first world problems, great problems to have, and problems that a lot of people in tech have. I know I came from tech. You got a lot of high salaries, and people who are having great exits like IPOs obviously have that problem times 100.
They do. And the reality is, George, is that people don't care whether they, win or lose at the art of financial independence or the focus of financial independence. And that's where, quite honestly, Wealthward Capital came out of my wife and I then post our first IPO in 2012, did a lot of work to start investing passively in real estate and commercial real estate to diversify our portfolio. There was a group of people that we had conversations around tech, careers, and money, and they started raising their hands and asking for help. And I realized at this point in time that when you work very hard to get to this sudden wealth event, and I use that term specifically because sudden wealth is actually a psychological syndrome. That once you have that success in a moment, and that could be, it happens to these young people that actually go through sports drafts, that all of a sudden they go from, I'm barely making it, to now I have millions of dollars. You get stress, you get anxiety, you feel lonely. And the reality is you don't know who to trust. And so this is where I think there's a real opportunity. And what I'm trying to do is come as a insider who's actually now executed a lot of this stuff, go back to that community and talk to them, not just about how do you diversify, but also how do you think about investing your time and talent inside of technology? Because maybe, real estate isn't your game. You don't want to become a syndicator or operator, but you can use your career to get that, tech equity and then get that into passive income.
Yeah, excellent stuff. And I really appreciate the way you're out there trying to solve some really difficult problems in finance. And I understand you've actually got an entire education wing that's doing this right now. So you've got your book coming out.
That's right.
Describe some of these troubles out there, and maybe you can tell us more about your education program.
Sure. Well, it starts with the book. So, the book is the first part is, a lot of people, and you've probably heard it too, being in tech yourself, is, well, working for tech equity is a gamble. I don't know how to do it.
Right.
And honestly, it was my first experience when I went to work for my first startup. I'd left a very successful consulting career, was in almost 10 years, been getting promotions, was surrounded by, great mentors. I was burnt out. So when I made my first decision, I saw this bright, shiny, oh, this is amazing. Oh, I love this startup. Went to work there. Within a year, bad boss, nursing an ulcer. This thing wasn't going anywhere. And I had to say, what happened? Well, we make emotional decisions, especially when we're working in tech, we get burnt out. So I realized that I needed to think like an investor. And like we do in real estate, you have to have due diligence, you have to have a risk criteria, and you have to say, how do I have a process that removes the emotion so that I can really invest my time and talent? And so that's truly from an education perspective, my book From No-Do to IPOs coming out. And then before we launch that, we're going to be launching then later this summer, as I mentioned before, Tech Careers and Money Talk. I think, while I do have a series of webinars and I do educate, my investors, a lot of technology employees, we're going broader and opening up just this education arm for people to really talk about tech careers and money, because we don't have the conversation. And if you don't have it, then you don't know what problems you have and you don't know how to solve them.
Yeah, exciting and great progression too. Again, a lot of people in IT, they see this, right? Your salary increases, maybe get promotions, and the next thing you know, you got to figure out what to do with it. You've got to learn how to become an investor. You're not just a very highly skilled employee anymore.
It's true, and again, this goes into, I think our shared belief that you're not going to have a wealth manager who's going to keep you in the market that's going to solve this income problem for you. If you truly want financial independence, that I believe comes with income, and I'm talking, 7, 8, 9, 10% cash on cash return, that's not available in the market today. And even especially today, but we have to start looking at the alternatives, right? And when the bond market imploded in 2008, all of a sudden it went from, the 60-40, yes, you would have 60 in bonds that again would preserve your capital, give you income pre-2008. Then it became the 4% rule. So then now you have to have a nest egg of twice as much if you even want a glimpse of that retirement that you had before.
Yeah, amazing. And that one thing I found with professionals is you basically have to know the answer, and then you can go to your professional and ask them, hey, is this the right thing to do? It's very hard to find professionals who are willing to just go out there on a limb and say, hey, maybe you should go into alternative assets. That's not something you're going to hear. It's not the way that it's structured. And as we're recording this in late June 2022, you're talking about how the market is going. I just took a quick look, and it looks like we're down 88 basis points if you're in the SPX today. And that's just obviously right on top of us already losing 20% this year, being officially in a bear market. And this will probably come out in mid-July. So this is all, I'm sure, going to be still very, very relevant. But yeah, some huge and great problems you've been solving. And so I think one of the first things you did, as you mentioned, you did go into multifamily. It's a great,
that's right.
I would call it like a starter commercial real estate class, or maybe the gateway drug to commercial real estate. And it's a great place to be. I mean, I'm joking, of course. I'm in commercial real estate in multifamily, and it is a great place to be. So you had quite a bit of success in there. Why don't you talk about the multifamily just for a minute, and then we can hit on some of the things you're doing more recently.
Yeah, I mean, I agree 100%. Multifamily, I call it the meat and potatoes, right? It is really the core of commercial real estate. I think it's something that is easy to understand. Like most people, we started off, we started getting into some multifamily, then we got into some single family homes and realized this doesn't scale. And I think it's really easy for tech employees to understand multifamily, single family homes at scale.
Yes.
A lot, the income and expense line is very similar of what you're going to see. And so as in 2016, 2017, we were looking already at moving to Austin, Texas. And I think the Texas markets were very easy to understand from jobs. There's a diverse job market. Jobs were coming here. People were moving here. They're going to need places to live. There was a great base of multifamily that could be, that were open for value add opportunities. And at that point, there was, arguably fewer multifamily operators to choose from. And so you could come in, get into meetups, get very close to people, and really understand how that business worked. And that's where we started in investing ourselves. And then, as I mentioned before, as people started opting in to invest with us, we realized that we could play a role, my wife and I playing a role as capital partners and helping out on the capital side, investor relations, also doing our own due diligence. And so we built out a portfolio. At that point, it was 3,000 doors in Central Texas. So Dallas, Austin, and San Antonio. We like those markets. So easy to understand that you didn't have the, hurricanes or the coast that you did with Houston. And so that's where we essentially built our portfolio.
Great stuff. And talk about real estate at scale. That's something I like to use as sort of a buzzword. I came from a background as an award-winning data scientist. So we do everything in parallel, work everything at scale. And I know there are probably a lot of IT minds out there that are thinking just right along those lines. So let me see if I can bridge or segue to your next thing. You're noticing that these returns are kind of coming down, right?
Yeah.
You started investing, say around the Great Recession. Wow. Did you ever have some major tailwinds? And then we're getting a little closer to the present, and those returns are harder and harder to find. People are saying you've got to look at 100 deals to find one. And tell us what you found next and why that's such a significant approach.
Yeah. So it's quite honestly that, after 2020, right? Because 2020, we experienced some headwinds. All of our properties ended up performing well, but we definitely had months where we were delaying returns. And during that time, we had made an investment with a larger company in an ATM fund, automated teller machines, cash machines. And this thing paid consistently throughout. It had an above 20% cash on cash return. And it's a very interesting asset class because it's structured very differently. There's no appreciation. It's all depreciation, all cash flow. Your cash is coming back at you. Your capital is being returned. And then you're also getting the return of capital and return on capital at the same time. It's almost like a mortgage payment, if you think about it. Yeah. And as that was performing really well, I thought, oh my goodness, my investors would really enjoy some of this too, because it was definitely bolstering our cash flow while we were experiencing some headwinds inside of 2020. Everything started returning back to normal late 2020, and by 2021, it was going well. But that gave us a taste that there's other asset classes that can support this cash flow. And that was something that even as asset prices were increasing and we saw the returns, and literally today, as I was preparing a newsletter for my group, and I saw it had been 9%, 8.5%, 8%, year over year, month over month as we're acquiring properties. All of a sudden, it jumps down to 6% at the beginning of 2020. Then post 2020, it starts jumping down to, let's say, 4% cash on cash returns. And this is, again, we're operating in appreciating markets, major markets, Dallas, San Antonio, and Austin. So you can imagine, okay, these properties are appreciating well, but we knew that if we didn't get cash flow to ourselves, to our investors, that was not going to help us meet our plan of financial independence.
Now, I want to jump in there. You mentioned a couple of things. I'm fascinated by various asset classes, even though I sort of stay in my lane as a multifamily syndicator. You mentioned ATMs, and you say like the cash is really coming back to you. It's like principal interest payments. And really these things last about 5 years. Is that accurate? About
5 to 7 years tends to be.
And then at that point, you just got to rip the thing out, and there's nothing to sell. And
actually, there's the metals. So you actually do get a little bit of a bump. So you get to sell it for parts. But to your point, and here's the interesting thing. I don't know if you know about it, but it's I have these other legal terms in my head, but it's non-recapture depreciation. So think about it. It's not like real estate depreciation where, okay, now I want it back. Yeah. No, because you're investing in an asset where you get bonus depreciation. You invest 100 grand, you get 100 grand of depreciation the first year. And it's a get out of jail free card in the sense that you can then lay it over other depreciation and they're not going to come looking for that later.
Yeah, I love it. That's good stuff. So at the end, it's just scrap value. And that's why I've never invested in those ATMs, but it's very interesting. I mean, if you need solid cash flow, and hopefully you're not just pumping that all into your lifestyle, because you're not going to have any principal at the end. But if you manage it right, that can be a very interesting investment. And so then you mentioned some cash flow issues with your properties. So what class of properties are we talking about?
We're talking about B class properties, in B class areas. And I don't think it was It was, well, so we did have some problems, and I can talk about that because I think that's important for us to talk about. But it was just, there was nervousness. So what we did is we communicated to investors and said, we're going to start stockpiling cash flow just in case, you think about it, March of 2020, nobody knew what was going to happen. Let's just start creating a war chest. And then for many properties, that was alleviated within, let's say 1 or 2 quarters, we were back to returning, and then we caught up. But we did, the interesting thing, what I learned in 2020 was that micro markets matter. And in Dallas, we definitely got caught out, and we had a bit of a hangover with a few properties that had high occupancy, 94, 95% occupancy, but low collections. And when I say low, I'm talking 85, 86%, right? There was a good gap. There's 10% that wasn't paying. Texas had some programs. Obviously, there was federal programs that were trying to catch up. But we ended up finding a window and exiting those properties in early 2021. Everybody made money. Was it a home run? No. One was a single, one was a double. But what I learned is that micro markets matter in these larger MSAs. And so it's really important. And I think coming out of 2020, you also learn that, do you want to be building in an area where it's the service industry, where people are in restaurants, in theaters? That's really, those are the main employers, versus some other type that's going to provide diversification.
Yeah, great points all. I mean, the markets matter. Sometimes it's street by street. I'm in the Detroit area, and I can tell you, if you go out to Detroit and you take a look at the real estate market, you will see beautiful old neighborhoods, and then you'll see maybe the next street, you might have boarded up houses, and a few streets over might be beautiful old homes again. So yeah, definitely something to pay very careful attention to. But great story. So you got out of it. Nobody lost their shirts, right? You got some appreciation. You make your money back plus, but some tough times. I mean, we didn't know what was going to happen next. Everything was slowing down. Brokers, they just weren't getting the offers. People were waiting for the prices to come down. That didn't really happen.
That's
Although,
right.
In some isolated circumstances, it did. I mean, I felt like I had some pretty good luck in 2020, but difficult times.
Well, and so then getting back to, so then it took me on this journey. So then the ATMs, to your point, I didn't see that as an asset class where I wanted to do a lot of diversification into. Did I want some exposure to it? Yes. I think in our portfolio, we have probably around 5 to 7% exposure to ATM machines. But then it was what I wanted, another, main course asset class that I can bring into the portfolio that we can start moving dollars into, that's going to give us the cash on cash return that we want. And that's also going to be recession resistant, right? What's going to protect us with headwinds. And so I really started doing the bake off, early 2021 between self-storage and mobile home parks. And I think that self-storage performed very well during 2020. I think many people would tell you that. And part of it is the 3 Ds. It's divorce, death, and displacement. That's when storage just blows up, does very well. The challenge, though, I think with self-storage is supply. Supply can grow. Supply can really expand. The thing I saw in mobile home parks, because it's structured very similarly in the sense that, low dollars, very sticky, right? The tenants in mobile home parks don't tend to move around a lot. Once you get them in, create a good relationship with them. But the key was the supply. The supply is shrinking in mobile home parks. The demand is increasing.
This is a very interesting story.
That all of a sudden puts you into where you want to be from an economic perspective, which is I have a scarce asset, and so that is where I was fascinated by mobile home parks. I really started digging in, and I wanted to see, as always, my operator criteria is who's executing at a high level, and then who is looking a little, left or right of center, who is not just doing what everybody else is doing, but is doing their own method. And this is where I found my operating partners, operating out of North Carolina, where, our senior partner, Ryan Norris, has been doing mobile home parks in major markets for over 7 years, and, has built up a portfolio of 3,000 pads. And he was working with a guy, and they were buying in secondary markets, and they were buying smaller parks. They were buying parks that were 90 pads or less. Now, that's important because institutional buyers or people who are coming out of a lot of the schools that train people how to buy mobile home parks, right? Mobile Home U, are looking for 100 pads or above. And if it's 100 pads or below, nobody's looking at it. And you're going to love this. You're a data scientist. So check this out. There are states that have high density of mobile home parks. One of the highest ones is South Carolina. One of the ones that's in the second tier is North Carolina.
Right.
Then you look at these MSAs that are experiencing 7 to 8% growth, have high density of mobile home parks, and they're an hour and a half away from major metros, good highways, close to, railways and ports and businesses is what we're looking for. Fayetteville, North Carolina has 400 mobile home parks, 400 in an MSA of 500,000 people.
Wow.
Has tremendous growth. It's the home of Fort Bragg. For those of you who don't know, that's the home of JSOC, which is the Joint Special Operations Command. So, it has a lot of investment, a lot of dollars coming there. Pope Army Air Base. It also has 3 small universities, medical center, haves and have-nots, 400 mobile home parks. 100 meet the criteria of these larger players, 300 small parks. Nobody's knocking on the door.
Wow.
And what we found there was there's a type of owner that have built these parks from the beginning, low to no debt on them. They're tired. They want to get out, and they're managing it as a cash business. And I mean that from 2 perspectives. Number one is they collect 10,000, they put 6,000 in the bank. So, their books aren't clean. The other thing is the fact that they may be running it at 50 or 60% occupancy because that's what gets them to their number. All of these parks are not going to appraise. So we've essentially gone in there and we're buying in high density areas. We're right now in Fayetteville, North Carolina at, 600 pads with around 550 homes. And this is giving us a density so that we can run this, but we're buying that for, 20% below market because we're buying where other people aren't. And we're not having a lot of pricing pressure, a lot of competition. And so this is where we're seeing now, even in this environment, we're right now in our first fund getting 10.5% cash on cash return. We're still in stabilization, meaning we're at 60% occupancy. We still haven't rehabbed all the homes. So you can see what the upside is there. This is the opportunity we see. And from a economic headwinds perspective, if you're a multifamily, Class A moves to Class B moves to Class C moves to mobile home parks. You also have retirees, half of them retire without any savings at all, fixed income. They're going to look first at mobile home park because it's going to be half the cost of a, 1-bedroom, C plus B minus apartment building.
Yeah, and that's a great niche you're in, the under 100. There are a lot of mom and pop operators, and some statistics that I ran across recently that these places, they just really haven't kept up with inflation. So you might have had a pad that was worth, say X in the 1960s. And, that today, inflation has run far ahead of where that is now. And you can recapture some of that because you're going to come in there and you're going to run it like a business, unlike Ma and Pa, like you're saying, maybe they're just trying to get to their number. They just want to be retired or stay retired and maybe not actively manage it too hard. And boom, you can come in here and with your density, right? And that's another key thing, right? You may be buying the smaller mobile home parks, but you're trying to concentrate in an area so that you can get those economies of scale.
Exactly. And you nailed it in the sense that it's this running it as a cash business. They have different motivators and drivers that drive them. And it's not going to lead to operational efficiency or optimization, right? And so that's where we come in, to your point, run it as a business. And literally we're getting value added to this by getting lot rents to current rents, adjusting them to the market and then filling the park up, let alone a lot of these have empty pads that are open for infill. We have a 3 to 5 year plan that is going to see us, be able to take this, cash flow to where people need to be for real financial independence.
Yeah, and there's something you touched on earlier, and that's the supply. And I think I'd like to introduce this with, you mentioned there are places in the US that have a lot of mobile home parks. I want to say it was like 3 years ago, there was it was Miss America or what, and she said, yeah, I'm from South Carolina, we got the most mobile home parks. And there's a stigma here. Cities
Yeah.
don't like it. There's a lot of NIMBYism,
Yes.
and it's very, very hard to get these approved. Do you know any places that are looking at this as more of a solution to the housing crisis, that are more open to it than others?
From a building new, no. I mean, that is to me is when your boots on the ground and you're participating in affordable housing and you hear the lip service that comes from the government and how that translates into, what zoning is happening, what investment is happening, there's a complete disconnect. Where I think the opportunity is for, good operators. And I mean, our goal, and we are the Thrive Community Fund. Like, we do want to make sure that we're creating safe, affordable environments for our tenants. Really supplying a good, solid product like that can create relationships that will be with you for years. And our ultimate goal is to, get 3,000 pads under management in the next 3 years. And year one, we're going to be at 1,000 pads. So we have 2 more years, 2,000 pads to go. But I think it's really buying and preserving and doing the value add component on the ones that exist today, because I don't know. I mean, the inventory that's being built is just really lagging behind. And we're definitely not seeing the zoning or the permits being provided to build more.
Yeah, it's really sad. I mean, all across the political spectrum, it's been noted that people talk about affordable housing, but when it comes to my backyard, they've always got a reason to say no, and it's sad. But I do think that it is a problem that I think has come to the forefront. And again, as I do see people across the political spectrum talking about it, hopefully people can have some compassion and realize that it's important. I mean, I live in an area I would consider quite affluent. I got beautiful homes all around me. I want to say we're all approaching the 500s, if not already soon.
Yeah.
And yet we do have some mobile home parks, and I don't feel like I'm any the poorer for having these neighbors. I mean, it's really sad to me. I mean, I'm a developer too, so I just see it every time there's a new development coming. People just line up against it, and there's very few people, if ever, who would ever come to a city council meeting and say, hey, we need this, we need growth, we need a tax base. The people behind the desk, they know that. Your city planner knows that, and the council members, they know that, whether they say it or not. They know that, but you only ever hear the negatives.
Exactly.
Anyway, great niche. And you were talking about the great cash flow you were getting from the ATMs, and then the multifamily. That's something that gives you sort of the cash flow and appreciation. And I think that mobile home parks, to me, it's wonderful because you really you really bring the two together. That's one of the things that makes me want to invest in a mobile home park. I haven't done it yet, but looking for my first.
Well, and this is one of the things that we talk about in my group, George, is it's about building the portfolio. So have we exited multifamily altogether? No, like we still have a portion of portfolio there because, again, it's complementing. And so right now we are seeing great growth and appreciation in these core markets that we're still participating in Central Texas. The cash flow is not there. So what we're doing is, part of it is allocation of new capital and then also reallocating capital that's exiting others. We're just trying to ensure that our portfolio is providing us the cash flow that we need, to prepare us for financial independence. Because one of the things I always talk about is that you don't want to be in the situation where you've always invested for growth, you haven't built your portfolio for cash flow, and then you need the cash flow, because lack of liquidity is when you have to sell assets at a lower price than you want. So you want to plan for liquidity, build your portfolio for cash flow today, so that then when you need it, it's there for you.
Yeah, I love it. I mean, could there ever be a more timely message that you need liquidity? Because who knows what's going to happen next? I heard people saying, well, I'm going to reduce the leverage. I hate that advice, because I feel like, well, you can reduce the leverage, but you're going to have a payment every month. Doesn't matter what you're paying on. But if you have, reserves,
Right.
you're 10 times safer than if you just simply wanted something with lower leverage. You're still going to have a break even. It's just going to be a lower occupancy.
Well, and that's where, again, diversification, right? If you then have something that's kicking off, I mean, this is where my search said with something, and I found with the ATMs in the mobile home park that can give me double-digit returns in a down market, though that's where we all have to, do the due diligence, research the asset classes and make sure that our portfolios have those aspects in it, because we just want to make sure that whatever may not be experiencing the benefits of this economy right now can weather the storm to get to the brighter days.
Yeah, exactly. It's amazing to be in something that's counter-cyclical. And there are a few things like that. Mobile home parks, like you mentioned, that's basically the last, I hate to say it, but the last rung on the ladder. I mean, you got to live someplace. And if you can't afford to live anywhere else, those mobile home parks will always be full. Car washes are like that too, particularly, and it's sad to say, in lower income areas. Those people, they don't have garages. And that car is much more of a representation of who they are, even than in a more wealthy neighborhood. So you buy car washes in the economically depressed areas. When the recession hits, those people, they're still washing their car.
Yep. You're right. And that's, I think, is important to look for. I know I've talked to people as well that are into ice machines, right? Operating ice machines in key areas. And there are, I mean, this is where I think it's important for us to, like, there is the bread and butter that's real estate. We all know multifamily, and I think multifamily is great, but to build a portfolio, I mean, from a capital preservation play, there's farmland. I mean, farmland, and I know I'm a big proponent. I know Carter Malloy over at Acre Trader has built a phenomenal business where we can go online as accredited investors and buy pieces of farmland throughout the United States. There's even, I didn't participate in it, but I saw they had a citrus farm in Australia, right? But some of them gives cash on cash returns. But again, it's an asset class as well that's shrinking. So you have something where demand, who doesn't want to eat food? Food costs are all-time high. How can we farm more? Shrinking asset class, value goes up. Again, you have to think counter-cyclical and broader in this portfolio.
Yeah, and I love that data-driven approach. I was going to ask you later on about any other exotic asset classes you're in, but to the very, very wealthy, farmland is not exotic. You talk to most people and say, like, hey, I'm going to invest in a farm. It's like, what? But very wealthy people, Warren Buffett, I know he owns farms. I might get the name wrong, but I want to say, was it Bill Gates that was just in the news because he bought up so much farmland in some states that there was some antitrust issues. The very, very wealthy people know that farmland, I mean, the more essential something is, the more it tends to go up in a straight line.
Right.
And multifamily is like that. That's why I call it the gateway drug. If you want to get into commercial real estate, that's probably not going to hurt you. That's probably the easiest one to go into. And farming, talk about having a place to live. Well, having something to eat, that is the other main necessity in life. And so it's really hard for these things to crash. And like you said, development is ever encroaching. So it's not like we're going to have more farmland next year.
Not at all. Not at all. Yeah. And farmland itself in the United States is a $1 trillion asset class. And now it's just now that we're getting the access, I think, as, accredited retail investors, I would say, to get, access to participating in some of that, because some of this stuff just, wasn't available. It was just the ultra wealthy, but it's a very interesting asset class. I would say that's one of the ones that we're participating in.
Good stuff. Well, okay, so we did get off of this tangent. I think it's a fun one. I promise we'll get back to mobile home parks in a moment. But with your experience in early stage companies and with some exits, are you investing in any venture capital or early stage companies? Is that part of your plan?
I can't help it. It's like, it's one of those things where I allocate, like I look at everything through the lens of an investor, and I have to have a portfolio. And so in your portfolio, you have to have high risk, high reward. So yes, I do participate in venture capital. However, I know a lot of technology employees that will be, 80% market, 20% venture, and then they have nothing in real estate. I split my portfolio in half income, half growth. And then on my growth side, I usually take, 10 to 15% of that and put that into venture capital.
Yeah, great strategy. I'm doing the same thing myself. And you got to have cash flow. I mean, at least if you want to retire off of it. And private equity, early stage companies. I haven't done venture capital yet, but that's the way to do it. Figure out how much you need to live on, make sure you have more than enough cash flow. And then you can go into some of these high growth things. And hopefully you're investing as part of a syndicate or your local angel group, but that's a story for another day. That's really hard to do all that due diligence. And I know you know all about that, but I hope people don't just jump into it. I mean, if multifamily is already kind of a difficult thing, it's certainly more advanced than single family. That's definitely not something to leap right into. But I would love to ask you more about mobile home parks. There are a lot of caveats that go along with this. For example, sometimes they have septic on site. And I understand that some of them even have their own private utilities. Like, what is your risk tolerance? Are there certain mobile home parks that you won't invest in just because it's too risky or too much work or trouble?
Oh, sure. Like we try and make sure that we operate within a clear checklist of what we'll accept, what we won't accept. We want to make sure that it is on city utilities, city water. Now, we do take parks that do have septic systems. We have an experienced team now that can go in and vet those. This is the value of working with a, more experienced partner that has, teams, especially in the same state, that can come drop in, do due diligence, can also do key repairs on those. For the most part, we do want it, city utilities, water, and sewer, but we'll take on septic. But there are, as I got into this space, I didn't realize there's this whole concept of a septic lagoon. We don't touch those. Like, that is a whole, I guess it's been around since Roman times. It's a way that you create a lagoon as a leaching field. We're not about that. And then also, mobile home parks don't have an official rating system. They have a star system that was based on writings of a gentleman in the 50s, but it's stuck. And so, there's 1-star parks that, you and I would not feel safe going into. We usually shy away from those. We're trying to play in the space where, is it a, 3-star to a 4-star park is what we're trying to do value add plays at.
Great. And then what about some other risk factors? Are you willing to take on parks that have low or no occupancy?
No, usually we want to make sure that it's cash flowing. I mean, this is where we want to have a cash flowing asset that is positive to us right away. Even if that dollar is low, we just know that if we go into a park, let's say, and we took one over in March, 34 pads, 50% occupied, and it was getting, let's say a 8% cash on cash return. With that level of occupancy, we purchased it there. Then we rehab the homes and are starting to fill that in, because we can see that then we'll get to our threshold is we're looking at, can we provide to our investors a minimum of 10% cash on cash return, and then exceed that? We need to have it cash flowing at least within a couple points of that before we're going to purchase it.
And then do you hold indefinitely, or do you try to sell after the rehab?
Our goal is to have longer term holds, right? We see right now, we're trying to be different in this marketplace where you have a lot of capital being cycled back to you, meaning we invested in this is a true story, invested in an apartment here in Austin, Texas. A little over 24 months later, doubled everybody's money, gave it back to them. Great story. But now what do you do with the money? And this is happening a lot in multifamily. So our goal is to have high cash on cash returns. And we're looking at 10-year holds so that we could, again, be that place in your portfolio where you're not thinking about that capital coming back to you right away. That can be something that's a little longer view. And then we make sure that all of our parks are owned by separate LLCs. So that means that we have then all the flexibility when it comes to liquidity. Oh, let's sell a portion of underperforming parks, give capital back. Oh, let's, refinance a portion. Like we have all the flexibility in the world when it comes to how do we provide more liquidity or manage financing.
Yeah, those are all great things, because I think every investor is conditioned to think in terms of return, but it's not just return, it's what you're able to keep. And that government takes a big chunk out of it. So if you're not able to 1031 into the next one,
That's right.
Having a 10-year or an indefinite hold is certainly a differentiator in the market. That's really cool. Now, my audience here, I feel like we are all at least passive investors now, or trying to become passive investors. But there may be some people out there who just really don't know, like, what is it like to passively invest in commercial real estate? You want to walk us through that, and maybe you can give us a few tips. If you're just, Mr. or Mrs. Stocks and bonds, how do you get from here to there?
Yeah. So if you're Mr. and Mrs. Stocks and bonds and you're thinking about passive investing, I think, being able to be a part owner in an asset that you don't have to operate, that was the first thing that sort of woke me up and said, wait a second, you're telling me I'm not going to have to go plunge a toilet. I don't need to talk to a tenant, but I get all the benefits. I get the appreciation, I get the cash flow, I get the depreciation, so I can actually then lower my tax burden. It is a different asset class that when you complement that with a stock in your portfolio, it's very, very powerful. And quite honestly, this, in my mind, is the replacement. I got my head around it because when the bond market went away and I realized we need income, we need something that preserves our invested capital. We invest 50K, that 50K stays or grows, and then we get checks on top of that. We get income on top of that. We need that in our portfolios to make that work. The portfolio theory of, the 80s and 90s of the 60-40, where you want to have 60% in income, 40% in growth, still holds. And so I think for Mr. and Mrs. Stocks and bonds, it's think about that. And then like anything else, I believe even in stocks, you need to understand the underlying fundamentals of the company you're going to invest in. You need to understand the underlying fundamentals of real estate. And it's relatively simple. It's jobs, it's people, and then it's who is going to be the operator. Same way, who's going to be the CEO of the company, who's going to be the operator of this particular investment that's going to see your money done. And when passive done right is amazing, because you are getting updates, you're getting reports that you can see, getting a lot of transparency on the properties, and then you're getting checks, you're getting depreciation, and it's really magic. And it works well the same way it does holding a great stock that does very well in the market over the long term, is you feel a pride of ownership.
Right. Yeah, I'm hearing a lot of things I'd like to throw out there. First of all, you mentioned all this due diligence that you need to do. We call it passive investing, but really there is a fair amount of due diligence, right? You mentioned doing some due diligence on the sponsor. You mentioned understanding real estate, understanding the market. You got to understand the deal. So I hope that people do realize, hey, this is a lot easier than going out and buying that single family home, having to make the transaction, having to pay the taxes and insurance every month, make sure that everything is properly done. And when I compared my life as a single family landlord to being a passive investor, I thought, why did I ever go through all that? With the sort of returns that you can generally get, it just didn't make any sense to me anymore. That I could take, in some cases, a smaller chunk of capital, and somebody else is going to do all that work for me and probably give me the same cash flow, and considering the appreciation, probably do better than I would be doing as a single family landlord. I was hooked. It's
true. And then, but the thing that holds the same, and I know, for us, we still have a small portfolio of single family homes, is all the work is done in selecting the tenant. You select the right tenant, you vet the right tenant, you're actually in a very good position. And so this is where I think with passive investing, and I some people don't do this, but I think you should, even with stocks, is you want to vet the investment up front. As passive investors in whatever vehicle it is, our job is to understand and know the investment up front and know our risk tolerance. And then once we make the investment, then it's managing it, looking at it, understanding and making sure that it's operating how it should and being vocal. But to your point, it's a heck of a lot easier than any type of active real estate investing.
So what about vehicles to get into it? Because I know a lot of people, they may not have a lot of money on the side. So how do you get into this? if you don't have just tons of money in the bank?
Well, one of the things I think is so interesting is, and I speak to this in tech employees. I literally had this conversation last week as I got on the phone with somebody and I told them, well, you need to be accredited. Oh, well, we're not accredited. And I walked him through the income requirement, and I know he and his wife both worked in tech, and he's like, oh, we're accredited. So yeah. I always tell people, especially if you have two working professionals in the household, like check the requirements. I know people that are accredited and have no idea. That's number one. Number two, and this is one of the things I believe firmly in from, why I'm writing my book, is that if you're a W-2 employee and you want to get accredited, work for equity, figure out how to work for equity, because that is what worked for me. That's what I became accredited, because I stopped working. I was working in technology for almost 10 years for a technology company, for a consulting company that gave me employee stock purchase program, but it wasn't compelling. It wasn't changing my life. I then realized I needed to be a part owner in a company, because I call this Kiyosaki's bridge, where you get the opportunity to be the employee and the owner at the same time, and you get the upside. And even if you're just getting a quarter of your salary in equity, so if you make $100,000 a year, you get $25,000 in equity. That over time will get you to accreditation much faster than never working for equity. And this isn't in hyper growth startup companies. I'm telling people, go to work for public technology companies that give great restricted share units, RSU programs. There's plenty of them out there. And you don't even have to be in an engineer. You could be in marketing. I have a story in my book about a woman who was working for a product company, a toy maker in Kansas City. Her brother-in-law allowed her to come live in the basement and do marketing for a tech company that got acquired. And then she worked for this larger tech company, amassed a lot of equity, ended up then relocating to Austin. And now she's living here, much lower cost of living. And she's now being able to invest and diversify. All of this was, she believed in herself, saw herself as the asset, and went to work for equity.
All right, awesome. This is amazing, Christopher. And I'm afraid all good things have to come to an end. Are you ready to head into the lightning round?
Let's go into the lightning round right now. I'm ready.
First, what is the most important lesson in leadership that you've learned along the way?
Well, I say to be humble, stay hungry, and always hustle. And that's I actually have this on these little signs right behind me. And then the one at the very top is remain resilient. Those are my leadership lessons that I live by.
Love it. We need more resilience in this society, especially since the pandemic. Love that.
Yeah.
Tell us something about your real estate markets that most people wouldn't know.
I think I shared it earlier, but I think it's great to recap, is that we work in markets that have great density of mobile home parks. Right now, Fayetteville, North Carolina, 400 mobile home parks in an MSA of 500,000 people. That's different. It's very different.
Yeah, that is awesome. Good to know. And what is the best real estate advice you have ever received, or the best real estate advice that you'd like to give our audience today?
Invest in things that you know. And so it truly goes back to what you and I were talking about a little bit ago, is do the homework and understand it first, and understand how it works. It's not that hard. You can get your head around it, but understand it first, invest second.
Perfect. That's like Buffett and Munger 101. What's the worst real estate advice you've ever received? Or tell us a misstep that you see other people making that you'd like to help them avoid.
I think the misstep is people who don't understand fundamentals, again, behind some of the math, and they don't understand what conservative means. I think I've seen people make mistakes because they believe something's conservative, but they don't really understand what that means. And so they're actually investing more high risk than they know and or think. And I've seen that cause a lot of pain.
I love it. Yeah, you got to know what you're investing in. All right, so now let's put a little randomness into the meeting here. I'll cut the deck here. I've got these random questions. This could be anything.
Okay, let's go.
Just tell me where to stop.
Okay.
All right.
Now.
Okay. What do you love about your hometown?
What do I love about my hometown? I love about my hometown is I grew up where my grandparents were, where my parents grew up. So I just had a lot of stories. I could walk into random places and people would tell me stories about my family that they'd never told me themselves. And so I absolutely love that about growing up. And I felt like it was a unique experience because as I've talked to people here in the US, many people move around and haven't had that experience. So that's something that is near and dear to my heart.
Awesome. Now let's give our audience a book that has helped to forge you as a leader and as an entrepreneur.
Well, as an entrepreneur, I've read this book by Mike Kim. It's called You Are the Brand. And I think as an entrepreneur, many people miss out on the fact that, when you get to education, when you get to real estate, people need to know, like, and trust you before they're going to take your education. And part of that is developing your brand. And part of developing your brand is understanding your principles and your story. And I feel like that book really just walks you through it step by step and has been a game changer for me.
Love it. Personal branding, very important. How has a failure or misstep set you up for later success?
I mentioned this earlier in the phone call, but when I went to work for my first startup company, it was an abject failure. And I literally thought that I'd screwed up my career and that it was very much a low point in my life. However, figuring my way out of that and analyzing and having the courage to go back and say, what did I do wrong? What were all the missteps I took? Actually forged the path for me to go to work for an incredible startup where we had a multiple seven-figure payday and move forward and create a lot of things. And so that was, one of the biggest failures I've had, but I've come to understand that it's in failure that we learn our greatest lessons. And if we embrace that and embrace the failure, we can compound our learning.
Beautiful. Now, can you send us out with a quote that'll help to forge our listeners as leaders and entrepreneurs?
As leaders and entrepreneurs, I think it's always important to understand that regardless of the thresholds that we get to, that we are still learning, that we don't know everything. And so my encouragement is to stay curious, ask questions, because hubris and believing that we know everything is actually going to, I believe, keep us from accelerating, keep us from, getting more business, getting more clients, where staying curious, I think, will constantly open doors.
Great. One of my favorite traits. And thank you so much for coming to talk to our audience today. I know that this has been a power-packed interview and very valuable. So thank you so much for your time, Christopher.
Appreciate it. Thanks so much for having me, George.